Hi, over the next couple of minutes, I want to talk about what's going on with rates. We have a situation where the US Federal Reserve has just indicated that it might be open to rate cuts. We have the European Central Bank indicating that they might have space opening up for lower rates, and the RBI, which has officially changed its stance in favor of what's called accommodative monetary policy, which means they too are signaling lower rates to come. So, what does this really mean in terms of a change in the rate environment, and therefore what does it mean for our portfolios and for our investment decisions? I think underlying factor for all of this is the fact that we are going through a global coordinated slowdown. We have seen the data coming out of US, China, Europe, Japan, and indeed in India, which point to the fact that growth has come off and inflation remains low. The data that came out of China, for example, even before the US-China trade wars escalated, indicates that the Chinese economy was already slowing and probably will slow more after this latest round of tariff increases. So it's going to be an interesting period of time. And the RBI finally has changed its stance from neutral to accommodative. Just last year, they were in what's called a calibrated tightening stance, which meant that they were expecting to hike rates. And in a space of about 6 months, they have moved to an accommodative stance as inflation remains below their trajectory, and as we saw, GDP growth also has slipped to below 6% mark. What does the phrase accommodative mean? Largely it means that rate hikes are off the table, and from every meeting here on of the RBI's Monetary Policy Committee, under an accommodative stance, the decision is pause or cut. So essentially, the market will start pricing in more rate cuts to come. We've seen that already in terms of the move in 10-year G-Sec yields, which have fallen quite sharply over the last month or so. Going forward, what can we expect from the RBI and from the markets? For one, we do expect the RBI to remain on an accommodative stance, or at least with a downward bias to interest rates for the foreseeable future. Some of that has been priced into the market. The key risk I think the market's waiting for is to see how the budget turns out. From the macro perspective, the economy does need some support. This support can come in two forms: a fiscal impulse or a monetary impulse. What that means is, if the fiscal deficit widens, then the RBI may yet judge that they may not need to do too many rate cuts. But if the fisc remains on a broadly consolidating path, that opens up space for more rate cuts from the RBI. So the budget becomes very important, and in our view, that will set the tone for the rate cycle in the medium term. Nevertheless, we do believe that the RBI's accommodative stance presents some interesting opportunities for us. The expectation is that the RBI will arrest any significant rise in yields from here on. That is to say that the RBI will provide liquidity and provide rate guidance in a way that we will not see sharp negative surprises or spikes in yields. So on average, most of our funds are running longer duration than they were in the past. What this also means is certain pockets of the segment which have been affected by the previous rate hikes and tight liquidity stance may now benefit if the RBI actually delivers on its promises in terms of easier liquidity and lower rates. We have previously discussed this tight liquidity environment affecting short-term bonds, where the yields are running at multi-year highs relative to the overnight rate. If the RBI delivers on the promise of easier liquidity, that's a segment which historically has been stressed, which could actually benefit the most. Longer-term bonds too should benefit from lower rates, but as I mentioned before, the key view there is actually going to be the budget and the fiscal policy. We are tactically bullish on long-term bonds, but what tactical means for us is it's an opportunistic play. It's not something we expect will be a structural play over the years. But short bonds is something where we continue to see value, and our positions are built around short portfolios with tactical long positions. For most investors, we believe, therefore, the real opportunity lies in short portfolios. And if you choose to want to play some interest rate sensitive, some duration opportunities, we believe products in the dynamic bond space will be more suited rather than absolute long duration funds. As I said before, the long duration plays seem to be more of a tactical or opportunistic in nature. I believe the current interest rate environment, both with RBI and the global central banks, presents therefore a very interesting opportunity for fixed income investors.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.